Okay, students, welcome back. So we'll continue on talking about market efficiency where we left off last time. So our definition of market efficiency is related to the concept of consumer and producer surplus. So remember, overall, we're interested in this question of how is it that we can characterize the benefit that society receives from transacting in markets. Is it possible for us to say that one way of transacting is more desirable than another? And specifically, we're interested in figuring out what are the benefits to society from interacting and trading resources through a free market. And remember, when we say free, we mean one where there's voluntary trade. So one of the things we focus on first is that in a free market, there are just two primary parties. There are the buyers and the sellers. So let's see if we can characterize the benefits to the buyers. And we have this concept called consumer surplus. And we measure it as the value to buyers minus the amount that the buyer has to pay. So the idea is that when you walk into a market, you have a private value for the goods that you buy, and that's measured by your willingness to pay for those goods. It's the maximum amount you'd be willing to pay before you said, no, I don't want to purchase this good. And that's really private information. No one knows walking in, when you walk into a store, exactly how much you're willing to pay for a good. Just take the example of somebody walking in to buy a bottle of water in a convenience store out in the middle of the desert. They don't know if you've been walking for miles and you're on the verge of dehydration, or if you're somebody that just stepped out in an air-conditioned SUV. In either case, you're going to pay whatever the price is that's marked by the store. And so that difference between your true value, your willingness to pay, and the amount you actually have to pay, that's consumer surplus. So there are also sellers in the market. They're the other primary party, and we measure the benefit to them of interacting in the market through producer surplus. Kind of in a similar way to buyers, sellers have private information too, which is their cost of getting the good. So a seller is actually going to receive some additional amount of profit, which we're going to call their producer surplus. And that's going to be measured by the difference between the amount they actually receive from selling the good minus their cost. So when we're thinking of society as a whole, we're just going to consider those two primary parties, and we're going to assume that there are no third parties that are affected by the transaction. And then we can measure the benefit to society overall by adding up consumer and producer surplus. So total surplus is going to be consumer surplus plus producer surplus. And you can also describe total surplus as being the value to the buyers minus the cost to the sellers. So one of the main results in standard economic theory is that markets are efficient. And what we really mean by that is going to require some time to discuss fully. But in short, what we can say is that when markets are competitive, then we'll have maximum total surplus achieved through the transactions that take place in the market. And that's really what we mean by efficiency. We measure efficiency by total surplus. So more efficient means more total surplus is created, and less efficient means less total surplus is created. So in addition to the idea of market efficiency, it's also possible that people might care about what we call equity. And that's this notion of fairness, of how the benefits in a market are distributed between buyers and sellers and other people. But to economists, the idea and the notion of fairness is really something that's best handled by others. We simply study how much efficiency is created, what total surplus is, things that we can measure. Fairness is not something that has a well-accepted measure, so we don't talk about it much. Okay, so here's an illustration of consumer and producer surplus in the market. You can see the demand and supply curves, and you can see the points illustrated. So the point E in the middle is our equilibrium price and quantity. And consumer surplus is going to be the area below the demand curve above that equilibrium price. It's the price that consumers are paying, and to the left of the equilibrium quantity. Producer surplus is going to be the pink area illustrated, which is the area below the equilibrium price and above the supply curve and to the left of the equilibrium quantity. So if you add those two together, then you also have total surplus as being the sum of the blue triangle and the pink triangle. So free markets are going to allocate the supply of goods to buyers who value them most highly, and that's as measured by their willingness to pay. And that's the reason why when we look at the demand curve, the high point on the demand curve is measuring the highest willingness to pay consumer, and the low point on the demand curve, the lowest willingness to pay consumer. And you notice that the demand curve slopes downward because as we increase the number of units, we move down to consumers who value the good less and less, or are willing to pay less for it. And so free markets allocate the demand of goods also to the sellers who can produce them at least cost. So again, imagine competition between sellers for goods, and the question is, well, which seller is ultimately going to be able to supply the product? Well, the one who has the lowest costs is going to win that competition between sellers as prices get lowered. So when we look at the supply curve, we'll notice the supply curve is upward sloping. So those low-cost producers are the ones that are on the low part of the supply curve, and they're the ones that get to sell the first few units. So if for some reason production drops, it's always going to be the low-cost sellers that win out in the market. So free markets ultimately produce the quantity of goods that maximize total surplus, which is that sum or the addition of consumer and producer surplus together. So notice here, following along with the discussion in the previous slide, that the value to the buyers is greater than the cost for the sellers at every point to the left of the equilibrium quantity. That just means that the demand curve, which measures the willingness to pay of the consumers, is higher than the seller's cost as measured by the supply curve. So we know that there's surplus, the value to buyers, minus the cost to sellers. There's a positive amount of surplus associated with each of the units to the left of the equilibrium quantity. Similarly, as we move to the right of the equilibrium quantity, we can note that the value to the buyers as measured by the demand curve is underneath the supply for those units, which means the seller's cost is higher than the buyer's value. So ultimately, because the equilibrium outcome is efficient, meaning it's going to maximize these gains from trade or these additions to surplus, the social planner can leave the market outcome as they find it. They don't need to change anything if they're interested in efficiency. So the policy of leaving the market by itself is commonly associated with this French phrase, laissez-faire, which means leave things well enough alone. Don't interfere in the market. So it's important to note that in the competitive market, there is no market power. Market power means that there's some ability of a market participant to influence the prices. And if there's market power, it can cause inefficiency. Basically, it's going to keep us from reaching the equilibrium of supply and demand because those prices are going to be manipulated by the person that has market power. Now, market power can happen on the supply side or the demand side, but it really deviates from the primary assumption that in a competitive market, buyers and sellers are what we call price takers. By being a price taker, it means you can't influence the price. So it's also the case that in a competitive market, by definition, there are no externalities. Remember a little while ago I said that we assume when we're evaluating the competitive market there are no third parties affected. Well, externalities are exactly those third party effects which can create benefits or costs to other members of society as a result of the transaction. The most common example of an externality is pollution that's created when a good is produced, because that causes damage to the environment and potentially to other people. And those costs aren't measured in a free market because the producers of the goods don't have to pay the costs, the damages to the environment, unless they're made to through some government policy. But in a free market, in a market with no government regulation, where there's just voluntary trade, then we would expect sellers to ignore those costs. And so when buyers and sellers don't take externalities into account, then you can end up with a market that's inefficient if there are externalities in it, because those externalities, again, they're not accounted for by assumption by buyers and sellers. So in summary, remember that consumer surplus is the buyer's willingness to pay for a good minus the amount they actually pay for it. Consumer surplus measures the benefits to buyers from participating in a market. Consumer surplus can be computed by finding the area below the demand curve and above the price. And producer surplus equals the amount that sellers receive for their good minus their cost of production. Producer surplus measures the benefit sellers get from participating in a market, and producer surplus can be computed by finding the area below the price and above the supply curve. Overall, we expect that in a free market that's competitive, one where there's voluntary trade, that the market is going to be efficient. It's going to maximize total surplus, or the sum of consumer and producer surplus. And policymakers are always concerned with efficiency, but they might also be concerned about equity of economic outcomes. And there can sometimes be what we call market failures. So in the absence of market failures, we know that the market will be efficient, but market failures can come in the form of either market power, where someone's manipulating the price, or in the form of externalities. Thanks very much.